The Chinese stock market has just had its second best week in 25 years, coming off of the news that US auditors have passed their first stage of inspections of Chinese companies. It's difficult to explain exactly how important this news actually is. The big tech crackdown of 21 and 2020 has been all about Chinese companies and their untrustworthiness on US exchanges, and that is a big reason why most Chinese stocks have performed so poorly not only over the past 6 months but since the start of 2021. And now that the PCAOB inspectors from America are planning to leave the country within the next few days, it may be a sign that they have found no wrongdoing in Chinese businesses, meaning most companies will probably stay listed here on US exchanges. And as someone who has exposure to the Chinese EV sector through stocks like XPEV Motors and Nio, this is exactly the kind of news that reconvinces my conviction. And that is exactly what I'm going to discuss in this video. But as usual guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, let's understand exactly the news that came out on Friday that rallied the Chinese stock market by almost 5.5%, putting in one of its best days since the 2008 crash. As you can see, it was announced on Thursday night that US audit officials completed their first on-site inspection round of Chinese companies ahead of schedule. Now, this is obviously a sign of progress in an event that is so closely watched by most Chinese investors, because it has actually been shown that foreign investors have been the ones rushing out of Chinese companies the most, and that mainland Chinese investors have actually been buying stock in these businesses. And like I've already said countless times over the past 1 year that I've been covering Chinese stocks, the delisting fears around these businesses was simply unnecessary. These companies are extremely profitable and they're very high growth, which is something that the US-China relations are simply not going to be able to deter. It doesn't matter if they get delisted on NASDAQ, they can always be converted to Hong Kong shares, and somebody like Nio and Xpeng have already been diversifying their share structure to allow investors that flexibility if something were to happen in the US. And even if it turned out that some Chinese companies were not following US rules, the delisting would not have happened until at least 2024, giving investors plenty of time to recalculate their convictions. And so to me as an investor, this is not a surprise at all. The US-China relations have already been extremely strong when it comes to technology and business. The only problems we're seeing are in politics. And as we all know, politics are complete BS, and investors should not be focusing on them for long-term investments. And don't get me wrong, there's obviously serious political concerns around China and Asia, particularly with Taiwan. But in reality, those risks also exist with companies in the US, in Europe, and all over the world. So as an investor, your job is simply to balance the risk versus the reward. If the reward potential seems bigger than the risk potential, then that's when you take an investment, and it's your job to stick to your conviction and not panic sell based on any sort of short-term catalyst. And for those folks that don't want to invest in Chinese stocks simply because they've been going down for a very long time, I want you to consider this. Alibaba stock right now is trading at the same price that it was trading at IPO. As a matter of fact, right now it's trading cheaper than that. Meanwhile, Alibaba's revenue has almost 5x in that time, and even right now, with the slowdown in the Chinese economy, their net profits are 6x higher than their IPO in 2014. And with a forward PE of only $1.16 in the best case scenario, this stock right now is trading at historically undervalued levels and is much cheaper than any American company. Now, this does not mean the stock is going to start rallying tomorrow, but if you're an investor for the long term, this is an opportunity. Just because the stock has been going down every single time you buy does not mean your investment is bad, because that means you expect to time the bottom of the market, and there is less than 0.2% of people in the world that can consistently do that. And that too does not last very long. Because think about it, if people were really able to time the market consistently, then what edge would there be investing in the market? Because then everybody would be able to make money by buying stocks and nobody would have to work a job. But the reason why the stock market is difficult is because most people simply listen to their emotions more than their logic. And that is exactly why most people get phased out of these bear markets that we're seeing not only in the Chinese market, but also starting to see here in the US market. And with the Seng right now in a cyclical bear market and sitting at almost 22-year lows, the folks that stick to their conviction are the ones that are going to make money out of this market. Because an argument to not invest in Chinese stocks or any other equity can always be made when the market is hitting these peaks and troughs. And guess what? Every single time the fundamentals always seem bad. But if you use basic analysis and were patient enough, you made money out of all these previous crashes in the Chinese stock market. And so yeah, even though it sucks for the market to continue to go down every single time that I've been buying and investing in Chinese stocks, I know this is a part of the process and this is a test that I have to go through to make wealth on the other side. Otherwise, it would be way too easy for anybody to make money in the stock market. Just like if you go to the gym, you can't expect gains immediately in the next week. You have to be patient and consistent, and that applies to the market as well. And with something so temporary as lockdowns and COVID-0 policies in China, which are driven by a once-in-a-100-year pandemic, there's never been a more clear opportunity to invest in Chinese equities. Now, obviously, you have to pick the right ones, and there's still risk for downside and potential bankruptcies. But the risk to reward is simply unmatched, as the Hang Seng Index is trading at a PE right now of only $7 compared to 22 in the US. And for the people that think that China's government wants their own tech stocks to collapse and they don't want any form of economic growth, why the hell would they allow the PCAOB from the US to audit their companies in China in Shanghai? If China really did want to kill all their companies, they would simply let them get delisted from US exchanges and not allow the PCAOB committee from America to come to mainland China. But that is exactly what they did. And as a matter of fact, that was done through the Ministry of Finance of the People's Republic of China, which is obviously a state-owned organization. And if you really think that COVID-0 is a big threat in China, think about it this way. China's population density is 4 times as much as America, yet their doses per 100 people is almost the same as America, 244 compared to 182. And that's considering that China does not have an mRNA vaccine, at least since the summer. Right now, they probably are investing in vaccine technologies that are more effective, but because of the fact that they were trying to build their vaccine in-house and not buying anything from external countries, they had to have a much slower process of vaccination. And obviously because of that, China has to be more strict with their COVID lockdowns. And it is actually a good thing because it's going to prevent people from dying and losing their jobs because of serious health problems. These short-term lockdowns are much better for the long-term economy and business in China than literally losing 1% of your population due to COVID. And it is absolutely undeniable how much destruction has been done in the Chinese stock market given their strong fundamentals. The stock market right now is sitting at 1997 levels, but in that 25 years, their GDP has been multiplied by over 18 times, and their valuations were 20x earnings back then, and right now, they're only sitting at 7. And for the arguments around Xi Jinping wanting to destroy his own economy and that being a bad thing for Chinese stocks after the Chinese elections, what the hell do you think happened to the stock market in China in the past 13 years that Xi Jinping was already premier? Well, as you can see, the stock market returned almost 150% from peak to trough. So to sum it up, I personally think Chinese stocks are a good buy if you understand the country and if you understand the business that you're buying. But as usual, let me know your thoughts down in the comment section below.